Hey everyone, Mark Anderson here, construction worker turned zero DT hedge fund manager. Today I wanted to go over basically the VIX filter, determining which backtest are curve fitting and what is the correct way to kind of base our trades in regards to taking them when volatility is high or low and how that affects our results, separating the noise from what's actually legitimate. So when we deep dive into the VIX filter, it's a tool that I think a lot of option traders get wrong when backtesting, and that's the VIX. We're going to learn how this actually harnesses the power of the VIX for testing trades and how to differentiate what is a good proxy for testing and using the VIX and what is not. I think the biggest thing people get wrong is to view the VIX as a static number, like the long-term mean is 17 over the last 30 or 40 years. So when it's above 17, it's high, and when it's below 17, it's low or something. We have to think about it and how that impacts the way we backtest and trade. The VIX is basically the fear index of the market and calculates the expected move of the index using slices of the SPX over the next 30 days. It's not static though. It's always changing. So how do we view this change over time, and how does this impact our level of backtesting and more so our trading decisions? The VIX has a tendency to mean revert to an average level for a while, whether it's low or high over time, and then it can pop. The way I like to think of the VIX is it's almost like a comic book. It basically mean reverts at the bottom. It's like, pow, goes up, snap, like they're fighting in a comic book. It rips back down. It'll hang out at the top. Then it gets crashed, and then pow, again, it goes up, and then it'll mean revert at the bottom. So that's kind of a good way to kind of think of how the VIX basically behaves. So a VIX of 20 today may be very different than a VIX of 20 from 5 years ago, let's say. Because if we're going back and we're back testing an option strategy and we're just using a fixed VIX value filter, like above 15 or above 20, you're saying you only want to trade when the VIX is above or below this number. But by doing that, you're actually missing a huge amount of context. We could be filtering out some of the most really valuable data we could be using, or we could be including some periods of really extreme volatility that may skew our results significantly. That's where the concept of percentiles basically comes into play. So instead of saying when the VIX is below 20, you can use a percentage based on the historical VIX data. So say instead of 20, you can actually say exclude the top 10% of most volatile days since the SPX dailies period started in May of 2022. And we could do that quite simply with just putting in Excel, exporting all the data, and doing that such. Now, we're not looking for an arbitrary number. What we're actually looking for is to remove kind of the most extreme market swings in regards to the actual VIX number at the time. It's more of dynamic as a way to think of it, but it also seems like a lot more work, and it is, but the work's definitely worth it because it's much more insightful and realistic of what we're actually doing. So you're essentially accounting for the volatility shift that we're talking about if you're looking at a back test and how your climate actually changes over time. So let's say you've back tested a strategy and you have 500 trades in the data set. So you look at all 500 trades and the VIX levels for each of these trades, and you rank them from the highest VIX days to the lowest and say, okay, I want to exclude the top 10 or I want to exclude the bottom 10. So that top 10% of 500 would be the top 50 highest VIX values. So you remove those top 50 trades and you're basically saying, let's just see how this strategy performed well if we avoided these really, really wild market days. We could also apply the same concept to the other side of the spectrum too. So how does this strategy perform over calmer periods of time? And this is kind of the takeaway, which we're asking the question that we've recognized through patterns of the market. And this is what humans are best at. And then we're trying to quantify it in an unemotional way, where people often just marry the emotional thought of a pattern to some emotional indicator. But if you want to look at how something performs when the VIX is low, you could exclude, let's say, the bottom 20%. So you're not just blindly filtering out data without knowing what the result of that is, or basically comparing it apples to apples during a high vol regime like 2020 to 2022 versus a very low vol regime from like 2015 to 2017. That gives us a much more nuanced understanding of our strategy's strengths and weaknesses. Then you can compare your results with these filters and you can kind of see, how does this strategy actually do when volatility is high? How does the strategy do when volatility is low? And when we're starting to get really into the weeds, how do we take this knowledge from the back test and how do we actually apply it to the real world? So how are we actually going to do this to make trading decisions today? So remember how the VIX mean reverts, pow, poo, pap, like comic books, but that's the average level and obviously drifts over time. So we need to be much more aware of not only where the VIX is right now, but where it's been trending over the last few weeks, months, and even a year. It's almost like we're not just looking at a snapshot of where the VIX is today, but we're trying to understand the overall pattern of the VIX. It's like, generally elevated or it's pretty subdued. How do we incorporate that in our trading decisions? So let's say you want to trade a strategy that you've back tested and you see that VIX has been elevated for the last few months. It's been very consistent above a historical average, and your back tests show that your strategy does poorly when the VIX is high and that you might want to proceed with caution or maybe even when things calm down. So it's almost like you're using these back test results as a guide to put on your trade. But we're kind of adapting to the current market environment. It's not just a set it and forget it type of approach. We're using the VIX knowledge to be much more strategic and make much more informed decisions. On the other hand, if the VIX is, fairly low and your test shows that your strategy does not do well in those calmer periods, then maybe it's a green light to not trade it, or you have a little more confidence to, if it said that in low vol, you should trade it. So we're not just reacting to the market, but we're doing by actually using the VIX data historically in percentiles to understand the environment we're in and how we can infer our trade will behave in that environment. So that's when we're actually using the current VIX behavior to inform our decisions. We're talking about how the VIX mean reverts, but the average level can also drift over time. We need to apply this percentile based approach to different strategies over different segments of historical data. So instead of saying, I'm just going to remove the top 10% of most volatile days across an entire period of 20 years, you could say, okay, I'm going to calculate the dynamic percentiles based on a 2-year rolling window. So instead of taking that out of the top 10 most volatile days that all happened during COVID, you're actually doing it for each year or each 2 years, so you can infer a little bit how that works. Because a lot of people often say that volatility mean reverts when it highs and you should sell more when it's high, but it just doesn't happen that often that the VIX gets really elevated. And sometimes it goes from 40 to 80, like in 2020. And in other times, like in August, it goes from 65 to 15, seemingly overnight. Neither of which are really correct, but that's what happens when you filter out those extreme data sets. The biggest takeaway here is that the VIX is a fear index, and it's much more than a number. Even though it's flashing on the screen, it's a reflection of market sentiment that is dynamically changing over time. By understanding how the VIX moves, you can make smarter decisions about when to trade, when to hold back, and how to adjust your strategies. It's almost like you're not just improving your backtest results, we're really kind of improving our understanding of the market itself. And by doing that, this ultimately leads to better trading. The more that we understand the forces that drive market volatility, the better equipped we are to navigate these waters. So now that we've talked about the VIX for backtesting and filters, you can act on that signal for trading too. Maybe when the VIX spikes, that could be a sign of opportunity, or when the VIX is low, it could be a signal to stay out. Now, remember this, that we can quantify this as much as we want, but there are always unexpected events that kind of shake things up, which is why historical data is incredibly valuable for backtesting, but it can never predict the future. So there will always be elements of uncertainty and surprise. So we have to approach it with a healthy dose of humanity and humility. We're not just number crunching robots, we're humans beings trying to navigate a very complex and evolving landscape in the market. We started from the very basics of what the VIX is, how it changes over time, and how we can actually apply it to our knowledge in backtesting trading. The more we explore the VIX and how it reacts with the market, the more you'll discover. So let's go into some backtests, and I wanted to kind of show how we know if a volatility filter, which is a very good one for backtesting, is curve fitting or not. And we'll go in that now. So to kind of go back on the theory of what the VIX looks like over a period of time and how there's different regimes. So I think that a really good comparison here is we took the average VIX from each month, basically from a 10-year period. And you can see here that, 2017-ish area or 2016 through kind of like 2018 was historically one of the lowest volatility periods in history. And then, COVID in 2020 was obviously one of the highest volatility periods in history. So we can see that this kind of initial period from 2013 to 2016 was around an average VIX of 14. Then from 2016 through 2018, 2019, we had an average VIX handle of only 10. And then basically at the start of the end of 2019 and 2020 through SPX dailies in 2022, we basically had an average VIX handle of 30. And then VIX has been predominantly pretty low here since the start of 2023 here with an average VIX handle 14. And this just kind of shows on how we would basically calculate this. So what I did is I was basically in Google Sheets, and you can just go enter Google Finance, price, VIX close, and then you just have dates down from that whole period. You go enter mean, enter average. So this kind of shows, 20 percentile buckets since 2010 of where the average VIX is, and then basically the moves in terms of standard deviation, what happened with those. And you could see that if we were to split this up into 4 periods rather than just one 10-year period, we would probably get a much more accurate data set showing these different regimes of VIX handles. And this just kind of shows what I want to display specifically in a backtest, is that from 2020 to 2023, or pretty much pre-SPX dailies period, that would be the end of 2022, we had an average and median VIX around 24. And then from 2023, the first of it till the end of 2024, which we'll call after SPX dailies data, we'll basically say that, the average was around 20 and the median was around 15. So about half the data set will be out of there. Now, this is a very curve fit trade, and I want to test it. So you'll see a lot of this in communities where they will use SPX dailies data. And it's already kind of sketchy that they're using a days of the week filter on top of a move up filter and a VIX filter. But I wanted to break this down and show you maybe if this VIX max made sense. So basically what this did is it kind of excluded like median days of volatility in the end of 2022. And it basically excluded all high volatility days after that. And it was very profitable in 2023 and 2022, and extremely so in 2024. Now, if we look at this same exact mechanics, but from 2022 all the way to 2025, you could say, oh, this is still very good. However, when we look at this, it basically made very little money in 2020, 2021, and 2022. So all of this profit is effectively from 2022. And now if we look at no filter from this, SPX dailies point, we can see that it goes down from 28% PCR to 11% PCR just from those basically few high days. And then if we show this from 2020 forward with no filter, now it's only having 6% of returns. So looking at this now, if we were to apply the median filter from basically the data set of 2023 onward, so, this is all part of this really lucrative area of 28% premium capture here. One, we apply median days. So basically we're only taking it in times with low volatility. You can see that it has an 11.9% return comparative to the no filter basically over that period of 11.6% return. So there doesn't really appear to be much edge in filtering out the median high volatility examples when we're looking at this. Then if we were to do this from 2020 forward, we can see if we basically exclude all the high volatility ones, we have a 4.5% premium capture versus 6%. So now there's not much difference in those two either. So this kind of shows that I don't really believe in this filter, because we basically curve fitted the vol regime for the SPX dailies data, and people will justify this, well, everything changed after SPX dailies. But my counterpart to that would be, if we're using a VIX filter that we're excluding high volatility occurrences, that should work in 2020 and that should work before the time. Whereas when we compare basically no filter of VIX, and then we compare that to, excluding the higher parts of volatility, we see very little difference between that SPX dailies period and the period before, 2022 and SPX dailies. So when we use the VIX filter like that, you could see that they're actually quite common. So there's no real edge from the VIX filter in regards to this, where we have 11.6% and 6% versus 11.9% and 4.5%. So you could see that this VIX filter, if we were to spread it out in percentiles, does not perform much edge. The next thing I wanted to talk about is basically sequence risk. One, we're texting by delta, and testing by delta can provide risk. So if you think about it, if you always traded a 15 delta put, if volatility went from 15 to 50, you would be collecting more and more subsequent premium on each one of those trades. So you, when you're at a VIX of 40, could potentially be collecting 5 times more premium than when you were at a VIX of 15. So you're placing a huge amount of your testing on the path dependence that when the VIX is high, it should mean revert fast, which we know is just a much longer time period and doesn't actually work, because in 08, it definitely didn't work. And in 2020, it definitely didn't work. So it's not a good strategy because you're taking so much more risk and you can never really quantify what that risk is. And this is basically known to as sequence risk. So if you're taking more risk, being you could be taking 5 or 6 times the bet size with the amount of premium you're collecting on a 10 delta and a high VIX. If that loses, it could have a extremely skewed result on what your result is. And not saying that anything of this is wrong, but we need to test it with a more nuanced case. And the best way I like to describe it is like if this 45-degree line is our perfect expected return, when we start introducing sequence risk, we're just guaranteed to be above or below it. So you could say you have a feeling it's a good bet. I don't think it's going to happen, but it's not really based on data and it's not a quantitative concept to go after. So that's why I would generally recommend that people credit target. So in a low VIX, instead of selling a 15 delta, or maybe you still sell the 15 delta to get the same 85%-ish win rate, you would just sell however many contracts it takes to risk 1% of your account. So maybe in a high VIX, you only sell a 2 lot, and in a low VIX, you may sell a 6 or 7 lot. And when we talk about why we should do this, we could think of business and how some of the most profitable businesses on earth, like casinos, do this. So in the example of expected win rate, so casinos obviously have a built-in edge in roulette. There's several green panels on the red and black board. And in the game of roulette, we basically know fixed results, which aren't quite like options, but we still play probability. The house has an edge of 5.26%, which means that over many games, the casino should expect to win 5.26% of all money spent in the casino on roulette. And the key with this is very similar to premium capture. When we sell $1 of premium, we hope to collect or keep 5.26 cents of it. However, in a lot of high roller areas, they have no bet limits or kind of dynamic bet limits, which can significantly basically hold some risk that if someone's constantly losing in roulette, they may go from a $200 bet to a $400 bet, $800, $1,600, $3,200, $6,400, and hoping they can recoup their losses, otherwise known as martingale betting. So this has a big vulnerability for the casinos, is that when people continue to bet higher and higher amounts, that if they have the bankroll to do so, the casino could win, let's say 54% of the time, or however often they're supposed to win to realize that 5.26% return. But if they lost on a really big bet of someone on their 5th consecutive loss, quadrupling their bet, they could have had the correct win percentage, but they could have lost money and had a negative expected value because they didn't control their risk size. And this is why casinos basically have table limits. Is if you go to table, they say the minimum bet is $50 and the maximum bet is, let's say, $200. And the reason why they're doing this is they're basically controlling their standard deviation of returns and controlling their risk per trade. So people play more often and they know they can realize their edge. So this is very important when we trade too, because in times of higher volatility, we're essentially martingaling down on our bet, which could be a good thing or it could be a very bad thing because we're not playing the probabilities as much and we never know how long, crazy events could actually occur. For example, the Monte Carlo analysis is actually named after a casino in Monte Carlo, where I think they had 26 consecutive reds in a betting case scenario, which is like a 1 in 12 million shot, but it happened. And that's why we run simulations on it now. So the key takeaway with all of the VIX stuff that we've talked about is you need to understand how the VIX mean reverts over time and kind of looking at different regimes on smaller periods to see if it's a good filter or if you're just curve fitting. And the other takeaway is if you're trading delta, you may want a credit target, or you may want to look at having kind of a table limit risk size of 0.5% of your account to 1% of your account on each of these subsequent trades, and the value of creating many more occurrences. Because when we have a stable risk amount and a stable allocation to our trades during times of extreme losing streaks and bad luck, it will not blow us up because we take the same amount of risk and we're essentially playing the numbers in the most responsible way we can, which can lead to a less volatile P&L and helping us get to our edge in a quicker period of time. I hope you guys enjoyed this video. If you like these kind of mathematical concepts followed up by backtest, please let me know. We'll also link a Google Forms in the description if you have any other specific questions on basically what this looks like and how we can add more value to you guys as well. So appreciate the time so much, and in service, 0 day mark. Thank you.